Hey, and welcome to my channel. In this video, we're going to talk all about equity and answer some of the most common questions revolving around it. But before we get started, don't forget to click the like and subscribe button as it's completely free and it really helps us kickstart this channel. For the most part, when considering compensation at a new job, all you really had to think about was your salary and benefits. But now, if you were to consider working at a tech startup in addition to your salary and benefits, it's very likely that you would receive equity as part of the compensation package. However, as gray as equity sounds, it isn't as simple as receiving 10% of a company, wait till it hits $1 billion valuation, and then walk away retired. I wish it worked like that. Not only is there a lot of complex language around equity enough to make your brain hurt, but there are a lot of other different forms of equity, terms of equity, timing, and tax implications you have to at least be aware of before you sign on the dotted line. So without further ado, let's get started. What is equity? If you haven't seen my previous video where I talk about salary versus equity, please stop right now. Watch that video and then resume this one. Just as a quick recap, equity represents the percentage of a company that you own, so in the most simplest terms, the higher the company's valuation, the more your equity is worth. Now, it gets a little more complicated than that. When you receive equity, you aren't just getting equity. Equity actually comes in different forms. The most common form is stock options, which gives you the right to purchase the stocks at a discounted price, also known as the strike price. And you can purchase the stocks at the given strike price, which is also called exercising your options. The strike price is typically calculated from the fair market value of the company's stock when it was granted to you. Stock options usually fall in two common types: incentive stock options, ISO, and non-qualified stock options, NSO. And the main difference is really around how tax is structured around each. For ISOs, or statutory stock options, the idea is basically that you'll be able to purchase stock shares at a discounted price and have the profit taxed at the capital gains rate and not the higher income tax. You won't be taxed when you buy ISO, and you only qualify for the full tax benefit if you hold them for at least a year before selling. You will be taxed at the ordinary income tax rate if you choose to exercise them immediately. These are usually given to founders and early employees and executives. NSOs, on the other hand, is a type of option where you pay the ordinary tax on the difference between the price the options were given to you and the price at which you exercise the option. You are taxed when you exercise and sell your shares, and these are typically more common than ISOs. Other types of options are restricted stock awards that a company will only give to you when a certain requirement typically relates to timing or a company's performances are met. They're usually taxed as income when exercised. Restricted stock units, or RSUs, represent stock shares or cash that a company will give you at a future date, also known as the settlement date. These are usually granted with restrictions, for example, vesting being one of the most common reasons. This is a relatively newer form of equity that we're seeing and is used both by public and private companies. RSUs are great on one hand because you don't actually have to spend upfront to buy the shares, but on the other hand, be aware that they also do get taxed at the time of vesting. Employee stock purchase plans, ESPP, allow you to purchase at a discounted rate, typically through payroll deductions. Without going too much into it, ESPPs also are usually taxed when the stock is sold. So what is granting? When you join a startup, you typically are given the job offer contract to review and sign, in addition to a stock option agreement that will outline all of the dates, terms, and details that are related to your granting or offering to buy stocks and the price you can buy shares at. As part of this document, you'll typically also get information about the type of stock options you will receive, the number of shares, vesting schedule, and the expiration date. What is a vesting schedule? As I touched on in my previous video, stock versus equity, you can't usually exercise options on the same day they're granted to you because most of them follow a vesting schedule. Not only that, you also normally wouldn't get all of your stocks at once, as you typically get them over a 4-year period. How this works most commonly is that you'll most likely get a fourth of your options at the end of the first year, and then 1/48 of your remaining options every month after that. Once your options are available to vest, you can then purchase them if you want. So just to nail this point home, if you receive, let's say, 1,000 shares with a vesting schedule, you actually don't own any equity on that day and will only earn them over the company's specified vesting schedule. Along with the 4-year period, it is also common to see it with a 1-year cliff. This means that you only start vesting after you've been with the company longer than 1 year. If you leave the company within your first year, you will not get any equity. This is pretty common as it's a great way for founders and companies to prevent job hoppers or short stinters to walk away with a piece of the company. There's also a chance that your vesting schedule could get affected or even accelerated upon a successful exit or liquidity event, typically in the form of an IPO or an acquisition. There is no one right answer here. It really depends on what is stated in the initial contract, so make sure you check it. So when can I sell my shares? So when can you exactly cash in on your vested equity? This usually happens when a company undergoes a liquidity event, as mentioned before, which generally loosely refers to an IPO or an acquisition. At this moment, your company will essentially convert shares of ownership into nice, hard cash, and you can then cash in your equity and cash out. While uncommon, employees can also sell their stock back to the company or within a private transaction with investors. There has been a rise of services like second market or shares post that allow employees to cash out before an exit. As an example, SharePost worked with Facebook's employees back in the day who were selling their shares to investors before the company's IPO in 2012. What are the tax implications? It's so crazy to see that there is so much talk and emphasis on people's equity and valuations and how much they're cashing out, and not so much about how much taxes they have to pay at the end of the day. Bottom line, if the current valuation or fair market value is greater than your strike price, you will 100% have to owe taxes when you exercise. As the difference grows, the more money you'll owe. Basically, if you buy shares, the IRS and the government will consider these to have value. If the valuation of the company is higher than your strike price, you're making a profit, and it is this profit that will be taxed. How long do I have to exercise my stock options? Typically, you can only exercise before your company's PTE or post-termination exercise period ends. If you don't exercise after that, you can no longer exercise your options and they'll go back into the company's option pool. While I have seen some as low as 2 to 3 months, many are now offering more generous periods like 5 to 7+ years, or as long as you have worked at the company. Can I exercise early? This means that you have the right to exercise your options before they vest, and this is typically mentioned in your option grant or offer letter. The biggest benefit here is that you can get some tax benefits. If you have ISOs, exercising early can qualify you for a favorable tax treatment. Just remember here that you have to keep your shares for at least 2 years after the grant date and 1 year after exercising. If you have NSOs, exercising early can also help you start your holding period sooner so that you could pay a lower capital gains tax when you sell. If you exercise options as soon as they're granted, there is also a chance that you might not have to owe additional taxes because you'll be buying them at fair market value. When exercising early, just practice caution because 1, you have to use your hard-earned cash to exercise and can't pay for your shares by selling some of your stock, and 2, you can't guarantee if the shares and the company will increase in value in the future. When you exercise early, there's also a 100K rule that basically prevents you from treating more than 100K worth of options as ISO. Any options above that threshold will be treated as NSO. What actually happens when I exercise? Remember, you can only exercise your options until they have fully vested or after a cliff. So the day has come that you're actually allowed to exercise your options. What happens? There are typically 3 options. First is you can pay cash and hold. Here, you'll have to use your hard-earned money to buy your shares and keep all of them. This is super risky as you're not guaranteed a profit and all of that cash will be tied up in the shares until you sell. 2 is to exercise and then sell some of the shares to cover your purchase price. Here, you can exercise your options and sell enough of your shares to cover the purchase price and the fees and taxes that will be associated with it. For the remaining shares, you can keep them or sell them. 3 is to exercise and sell. Here, you can exercise and sell all of your options in one transaction. Some of the money will cover the purchase price, fees, and taxes, while you can pocket the rest. So what should I think about? While exercising shares can be extremely lucrative, there is never a 100% guarantee that you'll profit or make money. You should definitely consult a tax professional as well and not just take my word for it. Either way, there are some things you could ask yourself or start thinking about now if you're planning on exercising. If you want to exercise, can you actually afford exercising? Because it's not free and you'll have to use your hard-earned cash. What if your shares are underwater? If they're worth less than your exercise price, does it even make sense to exercise now? Also, how's the company doing? Are they growing, hitting milestones, or do they just generally seem to be on the right track? Try to also be aware of your own bias towards the company because you work there and try not to overestimate how well you think the company will do in the future. What happens if you buy shares and the company doesn't IPO or get any offers? Paying for shares is risky as you're using hard-earned cash, so do you even have a plan B if your shares never become liquid? Finally, can you afford the taxes? Depending on the type, how many shares you own, your tax implications can be moderate to significant, so make sure you plan accordingly. Well, that's it. And while that was a lot of information taken, I really do hope that it was helpful. If you have any additional questions I can help you with or want to share some of your own personal equity experiences or stories, please comment below. As always, please don't forget to like, subscribe, and click that bell. It's completely free and really helps us kickstart the channel. If you also want to follow me, feel free to add me at Preston_Park on Instagram and TikTok, as I try my best to post daily. Thanks again, and we'll see you on the next one.